Did The Big Short show how to profit from the 2008 crash? Imagine knowing a storm is coming while everyone else is busy building their houses on shaky ground. That's what some investors did before the 2008 market collapse. The film, The Big Short, tells the story of how a few smart investors saw the signs of trouble in the housing market and made money from it. They used a financial tool called credit default swaps, which are like insurance contracts against mortgage securities failing. When the housing bubble burst and millions of homeowners defaulted on their loans, these investors' bets paid off big time. The crash started because lenders gave out risky loans called ninja loans, which meant no income, no job, no assets. These loans were bundled into complex financial products called mortgage-backed securities and collateralized debt obligations. Banks and rating agencies told investors these were safe, but they weren't. The housing prices kept rising, and everyone believed that trend would never end. But the bubble popped, and housing prices plummeted. Mortgage defaults soared, and the value of those securities collapsed. The investors in The Big Short saw this coming and bought credit default swaps to bet against these securities. When the market crashed, they made huge profits because the value of the securities they bet against fell to almost nothing. The film shows how some hedge fund managers recognized the risks early and took action. It also highlights how banks and rating agencies ignored warning signs, creating a false sense of security. The movie simplifies some parts, but it accurately shows how understanding financial instruments like credit default swaps can lead to profits during a market downturn. It also points out how poor regulation and risky practices by banks helped fuel the crisis. Some banks, like Goldman Sachs, even bet against the market while selling risky securities to clients, which adds to the complexity. In the end, The Big Short is a story about how a few investors used their knowledge of finance to profit from a major economic disruption. It shows that understanding the mechanics of financial markets can sometimes give you an edge, even during a disaster. The film also reminds us of the importance of oversight and caution in the financial world. So yes, it does show how some people managed to make money from the 2008 market collapse by betting against the housing market and the risky financial products that fueled it.